Good morning, everyone, and time for another daily plan where we'll talk about levels to trade today and also a little bit about going forward, the road ahead for the rest of the year, the whole rest of the year. Just think of it, folks. If you find value in the content I provide, please like, share, and do whatever that social media stuff is that helps other people get the content, and maybe they'll get some value out of it too. I have a feeling they will. Okay, so let me cut to the chase and we'll circle back around to some of the other stuff. So, quick recap of yesterday. We came in on after making all-time highs last week. We kind of hit that 45-ish level intraday. Friday, we closed somewhere near 35-ish. Over here, somewhere in the 30s. And then we had the gap down on Friday, overnight on Sunday and then into Monday. And Monday, we just couldn't really get any traction. We opened up pretty much at the high of the day, traveled pretty much the expected range, not quite. It was about a 20-point expected move. In the Discord room, we were talking about the straddle price and trying to project, well, we've been this far, 69.20, the straddle price is 25. So what would it take to fill out the bottom of the range, which made it about 90, 95-ish, which is kind of pretty much where we bottom ticked. So that so that's where we were. Overnight session has been technical term, not much movement. And now we're heading into the holiday shortened week, etc. With tomorrow is the December quarterly, end of the month, and month end of the quarter, big JP Morgan collar that I've been talking about for, well, ever, but recently, really since October, November lows. Looks like the 7,000 is not going to happen, or even to get pulled up to there by the reflexive flow, unless we can somehow get on our horse and make it back to the all-time highs-ish. I'll show you a gamma chart on how that might be possible, not probable. Of course, anything is possible. How we might accomplish that. Okay, I've just recently started doing this, showing my daily plan, and this is what my subscribers get. And so we closed down 25 points. Oh yeah, see, this reminds me to point stuff out. We had IV pop a little yesterday, but that was the Monday effect. A few people were saying, oh my God, look, VIX is up 10% or whatever it is. That's a very standard Monday effect. However, what isn't a standard Monday effect was the VIX 9-day. The 9-day VIX popped around 25%. Whereas this popped around 8%, whatever, pretty standard, maybe a tad more than usual, but nothing to write home about. QUANTUITION, I didn't run the math, whatever. Being aware of the numbers and kind of intuition, pattern recognition, etc., you just kind of know what you know. And so what does that tell us? Well, that tells us that whatever was going on yesterday was more short-term 9-day VIX, as you probably remember. You're probably getting sick of me saying it, but I'm going to say it again anyway. Or maybe you're not. Maybe you're happy that I'm reminding you. Let's be positive. You're happy that I'm reminding you that the 9-day VIX uses the CBOE magic formula, Same one they use to calculate the VIX on a strip tranche of options, however they do it. This time projecting out into the future 9 days, and then finding the Friday expiration before 9 days, i.e. January 2nd, and the Friday after 9 days, which would be the 9th, if my arithmetic is correct. And that's what goes into the calculation. So, some short-term hedging, right tail, left tail, I don't know what. We do have FOMC minutes today. We do have this big expiration tomorrow, so maybe some repositioning. I'm not sure what it was. Doesn't really matter. And so that's kind of what happened in the vol space yesterday. All right, let's get back to the notes. That's the VIX 9-day thing. Somebody paid up in the air turn. Breadth was mixed. It was meh, 4 to 6 advances, decliner. Overnight was flat, like I just showed you. So what do we have coming up today? We have Case-Shiller home price index, pretty much meh, algos may wiggle because they always like to, but nothing that I'm projecting as being a game changer going to really change the trajectory of the day. FOMC meeting minutes at 2 o'clock. You can always count on some algo wiggles for that. They've been telegraphing and they've been out speaking, et cetera, et cetera. So again, we'll see. Okay. So levels and lines. Let's take a peek at this. So basically the 2-day range, as we've been looking at it, 2-day range, if we go to Friday or the end of last week, was 45 to 95, 50 points, 85, 60 points. Not even 1%, not even one standard deviation. And so here we are now, and we're testing the 6,900. Yesterday's low was down here at 90, 88. I'm calling it 85. I like to give myself a little wiggle room. As you all know, I like to sell iron condors. And so I like to always round down on the put side and round up on the call side. And now let's cut to the tape here. Let's cut to, if I can find it, here we go. Let's cut to option depth, which is what I like to use for my in-depth looking at the gamma setup. And here's where we are. So here's 6,900. Size, this is open interest, market maker position just for today. And we're going to look a little later at today and tomorrow, kind of a multi-time frame thing, because tomorrow is a much bigger expiration. So customer positioning for tomorrow or market maker positioning, potato, are going to have an influence on today a little more than typical because of their proximity in time and in strike and their size. Okay, so, and let me get my boy Vol Trader on. He'll be speaking next. So what do we have here? So here's 6,900. And you see below 6,900, let's look at the size of the bars. This is market maker long. Support, not really, but we'll call it that. Support, where market makers hedging, goes opposite the direction of the move. So when we go down, they buy. As we move away, they sell. But then if it gets too far, then it gets sucked back to these big bars, pretending nothing else is going on, sort of theoretically in isolation. So below 6,900, we got this target that puts us kind of right near yesterday's low, immediate target, which kind of takes us to the expected move, to the bottom of the expected move. So 80, somewhere in there. And of course, once you stall, you kind of can get attracted back up. So this area is going to be sticky. And up top, if we stay above 6,900, then 69.25, pretty much yesterday's high area, a little bit above it, is where there's selling, where it's going to be difficult to get over. However, should we get up here and exceed the expected move, thin tape, thin volume, whatever, FOMC minutes, I don't know, whatever, it doesn't really matter. We have this negative gamma ladder. Now, remember, market makers hedge in this direction. They buy in the direction of the move versus here where they go opposite the direction of the move. So this is telling us customers are long up here. People are long, starting at 30 all the way up to 50. And so should we be able to get over 25, which is kind of the top of the range of the expected move, so that already makes it like a 1 in 3 chance that we don't, that we do, or maybe even a little less, depending how, on I think 16% on each side. So it's not a great chance, but if we do, we have this ladder up. So getting back to the if then, if we do and this ladder up, then suddenly the JP Morgan collar at 7,000 becomes more of a factor. Okay. So that's the broad brushstroke of today. Let's get back to over here. So the straddle for today was about 25 when I took it in the morning, when I took the temperature. I always round it up a little bit. So 80 and 30, top and bottom. The straddle for Wednesday puts us down near 65 and 45. And for Friday, doesn't expand very much. I remember we have Thursday off. And here's that thing about it. So now I just thought this interesting as I was thinking about the straddle ranges. I guess that's interesting. I don't know if we did. We have a VIX 9-day of 11.3. If you do the math, 49 points a day, call it 50, call it 45, call it whatever you want. The 0 DT is pricing at 25, 26 points. So that's year-end compression is at edges with money was thrown out, and that's going to be a little strong decay fuel pushing us up. Or is Val underestimating, and can we get that 49-point move? That's the intuitive question. We'll see. Keep our eye out. And here's the roadmap that you were looking at before. I'm not going to go through the whole roadmap. There's a 2 p.m. to create wiggles, and here's where we'll be stringing nice and flat. And here's like a little sheet chart on the levels. Too many levels in here. Anyway, why? I'll show you why. If we go back to this, there's a lot going on up here. There's not a lot going on below. Dan is here. Yay, Dan. I'm going to let Dan speak in a minute, too. Dan's my buddy. He does some of this gamma stuff. He does good volatility modeling on earnings trades, on or on just regular, underlying stocks, including indices, whatever. He throws some ideas into our server. That's another part of what we do, and we're going to be expanding some of that coming year, 2026. But anyway, so why do I have so many levels up here? I have so many levels up here because we have the 25. We have Friday's close up here at 35. We have 45 all-time highs. So there's a lot of reference points along here, and I probably could have condensed it in that little whatever, but I didn't. Okay. Oh, wow, he says good evening, so he must be somewhere across the seas. Somewhere across the seas. Okay. I promised or threatened that I would show you the multi-time frame thing. And so I did this last night. Okay, so I'm up in the Finger Lakes. We're having a blizzard. We were having a blizzard yesterday. And so I often put these charts that you're going to see up in the Discord and either speak about them or scribble notes about them, whatever. I didn't have time to have to go take care of the goats. Yes, I have real goats. These aren't them though. And so I decided to do a write-up. People were asking me questions. I had more crazy lines than usual. Okay, so this is the 0 DTE, the same thing we were looking at, and these are the levels I just discussed. I'm not going to go over it again. I want to talk about the multi-time frame thing. South Korea. Oh, my pleasure. I really do enjoy sharing my insights and hopefully helping people just get a better grip or a different grip. Not that my grip is better than yours or yours is better than mine, but a different grip, you know, a more rounded view, because it's not mechanical. There's so many things going on out there in the markets, more than one way to skin a cat. That the more rounded view we could get, the more we could see the interconnectivity of what's going on. For me, I think that's the better. Okay, so, see this little guy over here? Running joke in my server for all the TA people, we have that gap fill from, we have the gap fill from Thanksgiving. Where is it? We have this gap fill. And you know, all gaps must be filled, like it's like gravity and the sun rises and sets. And so I'm just going to keep marking that gap fill. Maybe it's going to be in March, or maybe it's going to be in 2028, where we have a severe bear market. But that gap fill is going to live in infamy until it gets filled. So anyway, back to the back to the gap fill thing, and then I'm going to put Dan and Val on. Okay, but what I want to get to is this. Okay, so here, I'm using unusual whales now. Here is a combined yesterday and today position number. And so you see it's a little different. We have the 6850 here. We have some positive gamma to kind of act as support. We have a little bit of something here at 6875. So when you combine the 2 days, it doesn't look quite as dire as it looks today. There's a little bit more beneath us than it looks like. And of course, look, there's our infamous gap fill. Okay, so somebody's camped out there. Okay, and it's just, you know, I'm not going to go through the whole thing. So here's a critical observation. 1 DTE, when we look at the 6850, is larger. So the Wednesday 2 DTA overcomes a lot of the negative gamma from the 1 DTE. So of course, that's free dynamics. And here I just corrected it. Here I'm using gamma rather than position number. Of course, we understand gamma is dependent on how close we are to the strike and how close we are in terms of time. So that's a moving target, shifting sands in the desert. But the position numbers are static, so we can mentally extrapolate. If we go down, they're going to get bigger. If we go up, they're going to get smaller away from them if they're below us, etc. So I guess I want to show that from a gamma point of view, suddenly this below area looks a little better than it was. And so that's all I wanted to point out there. And again, all shifting sands, all shifting sands. And one more thing that let me actually, it's a good segue for me to get off. And uh, Dan, you wanna speak? You wanna say something to everybody?
How you doing?
Good,
Sorry for
good.
joining
Glad to
late.
have you here.
Yeah, hello, Vol. How are you doing, my friend?
I'm doing great.
Yeah,
I'm okay. Good morning.
good morning. So, yeah, you have everything here what you need. You shouldn't wait for me. Two, three things I can point out. Make it very quick. Most probably everything has been said. Some of the things I put in, I saw more bearish hedging flows. We had some bullish flow, but let me just wrap that up very fast because I'm on holiday, not really trading. That's why I will just give you my insights very fast. Things I'm seeing, the things I've noticed from flow. Silver has spiked up. Everyone is like in this mode. How long can this momentum last? But from the flow I was seeing and I collected, we had a lot of call buying, um, not really much of put buying. So it's still in a bullish regime. Also gold still in this momentum, and we see a lot of call buying. 1% out, or maybe in the money, 2 to 3% out, and not that far expiration. We don't have these most crazy leaps. So if you are in this kind of trades, you might see that the DEX chart is still showing some, let's say, some strikes which could be reached and some stability there, but we might get a dip there at some point, and but it's still a trade which is still valid, and maybe a trade you shouldn't chase if you haven't set that up yet. And let's see, what else am I seeing?
This was
Um,
silver. You were talking about silver.
Silver, yes, silver and gold, yes, because I'm not that interested in this kind of stuff. I just trade them for a short time. I know a lot of people stack that stuff up. I don't know, Vol, what you saw from your reports. Maybe you want to pitch in there. You want to talk a bit about the skew and everything. I didn't have much time because I'm AFK. So I just did a 2 to 3 minutes of preparation just to be able to add a bit of knowledge here.
Dan, I'm going to put you not really exactly on the spot a little bit, but when we were chatting this morning, you showed me a nice little layout for how you're looking at the market. We had a little comment about some of it, but it seemed really user friendly and actionable. I don't know if it's ready to screen share now or not, but just can you give us 30 seconds on it?
Oh, you mean the butterflies?
Yeah, the thing that you put in there, and I commented about the HVL.
Yeah. Okay. I will make this brief. And please, both of you, pitch in. There's a
Is it
strategy
okay
I've
if
been.
I screen share that while you're talking?
Yeah, do that. It's no
Okay.
secret. It's all out there. So this is just the latest stand I have. So basically, what is this? One of the most important things um, you should know about if you go into trading options is that they are forward priced. And I don't want to deep dive in how options are priced. You should know this by now if you've been listening to Paul and Vol. But one of the things I really love is sell buy, basically, not sell. Sorry, to for a tiny debit flies on the weekly expected move and on big GEX clusters. And why is that? Because you can put them in for a cheapish way, and normally you have
Okay,
very high return on the
I
long
don't think
run.
it's
Did
big
you
enough.
share it? Did you share it, Paul?
Yeah, I'm showing it, but I don't think it's big enough for people to see.
No.
Green screen it.
We can
So,
put it in. We can put it in. I will put it in and give some explanation. So to cut this short, the easiest thing is you look at a big index or a stock you're following or something, and you have a weekly range. If you use TOS, for example, like Paul, the weekly expected move is there. The ball will pitch in at a second, most probably, and will say, well, been telling you for a long time, the expected moves changes all the time. That's true. That's really true. But at some point, these prices have been arranged. There's always buyers, there's always sellers. And what do? I've refined the strategy so I won't dip in right now. Like yesterday, we had a nothing burger day, one of Paul's, not maybe favorite day, but a good IC day if there's not a movement in there. But is the expected move so important? Let's say there are a lot of calls sold at the expected move. We have a range of 10. If we reach that, people have to hedge. As if people have bought and they are interested to get out the expected move. What I'm doing is I'm just playing the odds of these level touching at some point. And you can put up cheapish trades there, cheapest flies, and is the master of flies here. So we've been very, very successful with that. Yeah, but take it from here, Vol. Maybe you can explain a bit more if you want about the
did you
expected
just
move and
say
how
that?
to.
Yeah, sorry.
and I love doing flies. Like you said, they're inexpensive. They're pretty resilient. Like if you're pretty wrong, you still don't lose a lot and you can make money, whatever. So
Do you
and we do a
guys
lot of flies here in the room, or I do it right here. So if I had more time, well, maybe we could model out one of the ones that so in theory, if we wanted to let's see how fast we could do this. In theory, if we wanted to do a fly for Friday, based on on your work, what would you look at? I'll put you on the spot.
Um, yeah, I can't see it that small. Let me make it bigger, Paul. Where's the expected move on the side? I don't know.
Second
I'm
move
not
is about 50 to Friday, which makes it a
about.
nice makes it a nice 50 mid fly ish.
Yeah. So
Dan,
yes,
did you say that you would basically install the flies at the edges of the expected move around those?
yes, something somewhere there. Except if I see bigger gamma levels, which might be targets or slow the move there. So that would make sense maybe to put some flies there too.
But
And
obviously, most of the time you will have gamma clusters from open
yes,
interest
yep,
large on the way before you
yes.
will reach the 50-point edge.
Absolutely. That's why I haven't finished. Maybe I should put that out and people to read that. I won't put the fly on in the beginning of the week right away because we need to get in reach of that. Let's say you have, I don't know, you have a lot of clusters, like you said, on the way up. I would put flies to the cluster there. But if we get closer to the expected move, let's say in a shot of 20 to 30% of the move, and
So
so we
if
have the
you guys
deviation there.
enjoy this kind of banter about expected move and where to center the fly, should we center it at the expected move, or maybe we should buy it on the accelerated path toward the expected move? But wait, is the gamma accelerating in that direction or slowing it? If that kind of banter interests you, you'll love it in the Discord, and if it doesn't, come on in and maybe you'll learn to love it. If not, a lot of times you guys kind of build it and they will come. It's not hard to whoops, not hard to see if we want to put a fly somewhere up here. Whoops, why is it not doing it? Go. If we want to put a fly somewhere up here and shift it up a little bit. try and get some acceleration up without looking at the, let's go say, let's be conservative, 40, that's 15 and 15. Something like that for 75 cents. That's pretty cheap.
Yeah.
$1.40 even, that's pretty cheap.
Where do you
Looking
place
for
the butterfly at?
acceleration into the expected move. Excuse
Which
me?
one are you looking at?
I'm just playing around. I'm looking at a 40, 55, 70, 15 wide call fly for Friday.
For this
Center
Friday?
55, the body.
For next Friday.
Yeah, for this Friday.
Next Friday or this Friday?
This Friday for January 2nd.
Okay.
They can also play it on the other side too. So how wide of a fly, that depends on you, so to speak.
Would
I'm a
go,
cheapskate.
10
I'm a cheapskate, so
10
I
wide
like
ball.
I
10
like
wide is
10
good in
15
SPX.
wide fly.
You do have right now, looking at January 9, if you center the butterfly, this is a 30 wide center 70-50. Goes around, it's about $3 on a 30 wide, so it's a 1 to 10 ratio, good payoff, and just under the expected move for
Where's your
January
center on
9.
that one? Where's your center on that one?
What?
Where's your center on that 30 wide that's that cheap?
30 wide, January 9.
Oh, January 9, okay.
The center is 70-50.
Oh boy, okay. All the way up there. Okay, I see what you're doing.
So the payoff on this butterfly is 1 to 10. I wouldn't touch a butterfly under a payoff of 1 to 10, by the way.
Right.
I see no reason. Anything under, it's just like doing a small long. It's exactly, you can just buy the same delta at the same premium pretty much. So like your 15 points is, let's say that's a 15 delta or something. You can just buy that delta. But I think the payoff, the bigger payoff is a function of,
Yeah, $1.95. That's pretty cheap. I'm putting one in for science. If I lose $200, yeah, I'll send you the bill.
You're putting on the January 9?
Yeah, I'm putting on the January 9th for science. It's $1.95. What do I care?
Let me show you some stuff for the morning, for our conversation here. As you guys did SPX and everything, I want to draw the attention back to the Qs, which yesterday.
Do you have a screen share for us?
Yeah, we can do that. Let me do that.
And now, while you're getting that ready, I just want to explain to people briefly. So when Dan and I and Val also were talking about the fly, we were talking about where the gamma levels are. And typically, rather than put it on just like that, I would spend the extra few minutes and look at January 9th and see, okay, so January 9th, we have, considering that it's that far out in time, we don't have a lot of, we have 70-30. We have some positive gamma, so you might want to center it up there. Even 69-75. So it's gonna kind of be a slog to get through this, but we have this ladder here today and tomorrow. And if we can climb this ladder, the whole picture changes. If not, then we're kind of stuck pretty much in the range we've been in, for the foreseeable future. Did that answer your question, Grateful Dad? Go ahead. Let me know when you're ready. Oh, there you are. Vol Trader. Okay. Yeah. Okay. Let me get my stuff off, and so that let me get your stuff on. Okay. Go ahead.
Yeah. Let me move this for a second here. Now I can see myself. Okay. So just a quick view on like the plain vanilla structure for the open interest on the SPX before I do the Nasdaq. So the way I map it is, as you guys can see, the puts are the purple bars, the green are the cold bars. That's just open interest, and I try to model the sensitive, areas where hedging might occur, or some type of hard stops. Like for today, you have that 69.20 in the money put, which is basically your main hurdle to the upside before it's a clear path of call domination from 69.25 and over. Now, this is pretty much the same setup as yesterday. Yesterday, I mentioned several times 69.15 to be reclaimed, 69.20 to be reclaimed before any upside would come in. SPX was bearish, and on the Qs, I saw all day buyers coming through the skew, lifting the near the money, out the money portion of the surface into Friday, into January 2nd. So in today's data, I see that even more. I'll go over it pretty soon. But from an SPX perspective, again, now it's pretty clear, right? If I say 69.15.20, everybody can just draw a line there on the chart because of yesterday. So it's pretty clear. That level, obviously, the more people can identify it, whether they use gamma or don't use gamma or just plain technical analysis, whatever you want to call it. Now you have a wider participation crowd that identifies that level. That's why it becomes even more significant than yesterday. And if the market were to breach that level to the upside, so obviously you would have a run of 20, 30 points. I'm sure that Doc went over that. So I'll leave it be. Now, potential range-wise, within the expected move, I have 68.90, around 68.90 to be like a, well, actually 68.80 to be like a crucial shelf. If we drop that, we go into, we basically might dump like more aggressively than one would expect on the Christmas week. I doubt that will happen with no news. And to the upside, I think the main cluster is around 69.35, 45, something like that. So that's pretty much for the SPX. Let me move on to the other stuff. So this is another mapping of the SPX, which I do, showing the velocity of hedging on a continuous move. So if you're continuously moving up, that, in my eyes, my model, the hedging would accelerate dramatically, depicted by the red dotted line. Now, what's interesting here, and this is where I brought the 68.80, the model says that while the transition is clearly around the 900, the 6900, 6905, right? Everything is above the zero line there. The actual transition, or the actual change in sentiment, for selling and stuff like that, really happens if we break 68.80. So theoretically, if the market is weak, we might dip into that level or close to it, 68.85, something like that, and then bounce back up to close around the 6900. But the weak point, in my eyes, is 68.80. If we break that, I think nobody's pretty much expecting that to happen on a week of Christmas. So that's the main level to watch to the downside, and 69.20 to the upside. That's pretty much on the SPX. Now, what I think is the more interesting part today, not because I like the Nasdaq more, but the data is much more interesting. So we'll start by modeling the skew of the Qs, right? When I say Nasdaq, it doesn't matter if you're looking at the NQ or the QQQ or whatever, it's all the same. So the consolidated view In this visual, what is interesting is the blue line, this line here that I'll just mark. Yeah, this one that goes from here all the way to here, right? That's my skew model. It's not necessarily something you'll see on the screen if you look, through an interactive broker or something like that. And what I find interesting is a clear crush of this section, right? I mean, if this is the skew, it should look something like that, right? But clearly seen here, the blue line here is pretty flat between 621 down to 615, and from there it starts, getting that slope, that natural slope you would expect. So all this area is a bit odd, and I'll explain what that means and why do we care about that. So first thing first, the flattening to the left side, to the put wing side, means they sold puts. So the deformation of the skew from spot, which is around 620, to the put wing is put selling. That's why we have this type of plateau break in this section, rather than have a continuous nice skew, continuous skew that goes up and doesn't have a deformation in the center. On the other side, they basically have this slope for the put wing, and then the further out put wing is broken with the trough being right here, right? So what this means is that they basically, if we would not see what I'm about to show, the analysis would be as follow. So you have the natural skew, which should have been like this, right? And now you have this area here. So this area would be, the first way to classify it would be that if this is the money, right, the 620 or something is the spot, so you have an elevation at the spot, right? So basically, if you flip it to the left a bit, you have this type of skew actually, where this is 620 at the money elevated IV, means they expect a down move generally. Okay, but we need to match that against different types of changes, from open interest, the gamma surface, and other stuff, to make sure that what we're seeing here is actually bearish, or that what we're seeing here is actually a tilt, an aggressive put selling from 620 to 615, right? Rather than an elevated at the money with a symmetrical put wing and call wing. So I'll just walk you through this pretty quick. I think this is actually put selling rather than an elevated, and I'll explain why. On the right here, this chart basically shows from a Z-score how the gamma distributes day over day, for the last 5 days. So there's a continuous bullish tilt towards the upside. No matter what we did with the market the last 5 days, they pretty much hold this long position, expecting the market to sometime between now and Friday, January 2, to trade towards whatever, 624, 626, 30, whatever. There is some type of expectation that the market will pop up, at least will tag a higher level by the end of the week. Now, we move to the final chart that will help us classify what we saw in the skew and maybe clarify a bit what we're seeing here with the Z-score. One sec. And here it is. So here,
he's got a lot of tools, doesn't he? He's got a lot of tools.
Yeah, these are all my
stuff you got.
This is all my Python feeding different Excels and shit. But not trying to be too sophisticated. Here we get a clear answer of everything I talked about. Whether everything is clear or not, it doesn't really matter, because this, once I explain this slide, it's pretty easy to understand. So what we're seeing here is my model trying to match specific trades that I look for in the options, which I think affect the most the way the market makers will price the skew. So while we can all buy and sell options throughout the day, right? And there's the 0DT crowd, very large crowd that can impact, okay? But there are not everything in terms of volume necessarily impacts the skew. You understand that the market maker machines will not necessarily change the IV if any 5,000 block goes through, right? There are more strategic things that the algorithms of the market makers are looking for over several DTEs and consistency to reprice the skew in a way that they think represents best the supply and demand. Now, when they do that, basically they show you their hands in the poker analogy. So they don't tend to do that too much, only if they're forced to. Back in the days, it was pretty easy. If you're Fidelity and it's noon and you just happen to call some market maker and you want to shop for 10,000 block on QQQ or whatever, calls for next week, right? So the market maker would immediately hike the IV for that strike, because first, he doesn't know if you're going to do the trade with him or not. But if you are, he'd rather price it right now more expensive just before you do the trade. Second, he would assume that you're already in the market talking to everybody and the IV will spike anyways. But nowadays, it's a bit more, it's much more complicated, and even more so to try and track it, sitting at home and trying to figure out what's going on. Now, this is the section which is very simple to understand and which explains why I went through all this analysis on the Qs. So this tries to capture those strategic trades that I'm looking for over the skew. So this is the this is the ladder of the strikes, right? This is the spot around 620, and these are calls. The left column here are calls where the black X is, and the right column here is puts. So obviously there are much more options traded, but again, I classify whatever I classify, and I try to understand how these affect the skew. And what you're seeing here is something that resembles to an open interest change day over day or week over week. And you can see that a lot of puts have been closed deep in the money. So this by itself is very bullish. This by itself being in the money puts closed mean that yesterday's dip for some reason triggered this crowd to liquidate or to monetize their put positions, right? And we saw that yesterday where we dipped and bounced back up. So this was part of the forces affecting that type of bounce. And because they are in the money, they don't really affect vol, but rather are delta. This is equivalent to somebody coming in and buying at that dip, I don't know, 5,000, 10,000, 100,000 futures, okay? Now, on the call side, much more muted, just a bit of position closing. This is the puts, this is the in the money call side. So this basically, if we're looking at this section versus this section, right? This is the put wing, and this is the call wing. And if you remember on the skew, when I went through the skew, we said we might have an elevated at the money, right? And so that will be an IV buyers buying at the money and elevating it deforming the skew, but nothing is going on the wings. He's just pumping the at the money, right? But what we see here is actually that there was a lot of influence on the wings, especially on the in the money put, right? So this is more an activity of wings rather than an at the money vol buyer. And because most of the activity is in the money puts being liquidated yesterday, right? I classify this as actually bullish. And back to the skew, right? Back to that first thing we saw. Where is that thing? Here? No, here. Here, sorry. So back to this.
Okay, and we're going to have to wrap up in a minute, so.
Yeah. So this section, because of what we're seeing, right? We're seeing a heavy selling of this portion and this portion, which I think indicates more a muted local market, even a bit bullish on the Qs, rather than something that is, somebody's buying volatility and expecting a big move down or something like that. So I think the Qs are still bullish yesterday and today. And this is expirations looking up to January 2. So the move, can happen today or can happen anytime between now and Friday, but they are building a long position. That's my final thought about these Qs. So big position being built over a couple of days. I would expect some manipulation from the news or some AI bullshit, Oracle buying God or something like that. And that's pretty much it.
Okay, and I actually put on a couple of flies the last day or two in QQQ, different expiries, smaller ones. I kind of sometimes like staggering them, one for the January monthly, one for the Fed to give it a little time to work, and then maybe something shorter term. Thanks, Val Trader. And so I've gone over I keep trying to tell myself a half hour to 40 minutes max, but that keeps not happening, but that's all right. I just want to show you real quick. So yesterday, what happened yesterday? So you're right. Yesterday on this very broadcast, I did this broken wing fly. Somebody asked about it. So we did a 1 DTE broken wing fly for a credit, just one for science as a demo, 60 cents credit, closed it for 20 cents. It filled at 9:30 at the open. We constructed it here, and it closed at 2:02. Quick, nice. If you did 5, 10 of them, whatever, that's real money. It's just a demo. And I sold. Looks like I sold 5 put spreads for today over here, 15 wide, and let's see how they're looking now. And here they are. And if I put in close at 50% profit, they're basically still where they were, and that's fine. I'm okay with them. I would probably want to add to that level, 68.45, 7 delta, 25 expected move, almost 2x expected move. With, as you remember, I showed you. I'll just go over here real quick, and then I'll get out of here.
By the way, Doc, there's one more thing. Let me know when I can mention it about the VIX.
Excuse me?
You said go ahead?
I'm sorry, you said something?
Yeah, I said there's one more thing that I forgot, which is kind of important about the VIX. So just let me know when I can.
Okay, all right. When I finish up, I'll talk. So I just wanted to show you that 50 that I sold for today, when we look at the Greeks combined today and tomorrow, so it's factoring in the relative weight and distance and all that, I've got between 75 and 50 positive gamma buffer. Now that's the difference, let's just say, between the way I might trade and somebody that's mechanical sell a specific delta, or like the IC whale, aka Captain Condor, who sells something mechanical and doesn't look at anything else. I'm purely discretionary. I take as much into account as I can and try to incorporate that in my trades and try to convey that approach to other people that you can overlay on top of whatever you're already doing, yeah, assuming you're already doing something. So anyway, go ahead, Val. Let's finish up. We got 4 minutes to the market open, and I need 2 minutes to get a trade in. So you got 2 minutes.
Yeah, so very short. I'm building into, I already did around 20 of those. I'm building into a March 17, 2026 call spread on the VIX. You can get a payoff of 1 to 5, maybe 1 to 6. If you're buying the VIX 20, selling the 25, you can get up to 1 to 9. If you're more aggressive, buying around the 25 and selling around the 30. So
Okay.
very, very, very cheap, extremely
Okay, let's
cheap.
hold that
skew.
thought, because
What?
I'm actually doing a write-up I have a write-up on the VIX, and let's do that in more detail, maybe in a day or so, whatever.
Oh, but the important thing is that it's very cheap now to buy upside
Yes,
VIX, and
it's
and
cheap.
It won't
However,
stay like that for a long time.
however, look
because
at the
people are
March
starting to buy.
contract. Look at the March futures, which that VIX is being priced off of. I like doing a fly, a different approach, and we can talk about it offline, whatever. Yeah, anyway. So we got 3 minutes.
Okay, good stuff. Talk tomorrow.
Yeah, and again, if you guys like this nuance and what fly to do and how the VIX is priced or whatever, come join us and we can all go down rabbit holes together. Okay, take care, everybody.
Bye bye.